Perfect. That takes us to the last option here, friends. Option 4. Himmat.
Yes. So option four, as I said, gift was specifically designed looking at the flexibility perspective, where someone wants to pay regular, get regular, someone wants to pay lump sum, get lump sum. So fourth option is where someone is paying for regular but getting a lump sum payout, where
Okay.
they do not want regular payout, they want lump sum payout. So an individual can pay for 5 years and get a lump sum amount on the 10th year. Similarly, if you look, someone can pay for 6 years and get a
Mhm.
lump sum payout on the 12th year. So here you paying regular. So it's like a saving habit which we want to create in an individual, where they are saving on a monthly basis or yearly basis, and they get a huge tax-free corpus at the maturity, which we are giving with life insurance cover embedded into it. So if you look at the example which is there, if you look, if an individual is paying and let's say x amount for 5 years, they are
Mhm.
getting let's say 2x or 3x amount lump sum on the maturity. So this is regular, in you pay regular and you get a lump sum benefit into it.
So what you're saying is, let's take an example. Somebody will pay, let's say, 10 lakh rupees for 5 years, and the plan will
Yes,
mature at the end of the 10th year. That is the
10th year.
5 year wait
Yeah.
period.
Yes, yes,
And likewise, so if it is 6 years, so whatever is the pay term is also equivalent stay term. Is that correct? So if it's 6 years,
yeah,
year will be 12th year.
yes. If 7, it is 15, and if it's for
Oh,
10, you can get for 20.
okay. So here, let's say if I have a dream that I want to send my son to Harvard, and I'll probably need a crore, I can plan that in advance, and I need it, let's say, after 10 years or 15 years or whatever. I can plan right now instead of opening an FD or a mutual fund where the yield may be reinvestment risk is there. We don't know whether the interest rate will fall after 3 years, 5 years, or whether the equity market will go up or down. I don't want to take any risk on those two counts. We can just simply subscribe to this plan, and there will be a guaranteed amount which I can know for sure will come out at the end tax free. That is that correct?
Yes, definitely. This is for someone who knows their goal timeline, where they know that goal is my sacred and sacrosanct. It cannot be, moved from their timeline. I know that it has to be fulfilled on that specific date, of be it higher education or be it retirement. So you inculcate the saving habit into a guaranteed product. So you get a guaranteed tax-free lump sum.
And as I see in that red box, which at the bottom, there is the life cover for the entire policy term. So, for example, again, if my friend were to invest, let's say, 10 lakh rupees for 10 years per annum, he gets a 1 crore cover not only for the first 10 years, but also for the remaining 10 years where he's fully invested in the fund. So, for 20 years, he will get that life cover. Is that correct?
Yes. For full
Okay.
policy term, you get a life cover.
Brilliant, brilliant, excellent. So, friends, just summing up the four plans that we had, which Himmat has kindly run us through. Plan option one, you have the gift income plan, uh, where you invest your funds. There is a fixed investment period for a particular period, length of time. You have to select your own pay term, wait for a year, and then your cash outflow starts. This option, as we saw, has its own benefits if you don't need immediate income. There you are getting a guaranteed income, as you saw, which is quite generous if you were to stick to that. This is the slide which sums it up. This is the income option. Pay for, let's say, 10 years, stay for just 1 year, and from the 11th year, you have a very, very hefty tax-free outgo. Of course, the life cover is there for the pay term plus the 1 year stay term. Option two, as we quickly will summarize, you get early income. If you choose the 10-year pay-in option, you get 25% of that amount which you have committed immediately, which comes from the second year onwards. You get regular income up to the 11th year, and from 11th to the 20th year, you get your lump sum payouts. So again, pretty hefty, pretty generous. All the income streams are tax-free. Again, as in the income option, you get your life cover for the first 11 years till you're contributing into the fund. Option three, very simple. It's an FD. You can select 5, 10, or 15 years. You pay in and you get paid out. Your cover is there till your maturity, the 10 times cover. Again, all the streams of income that IPO gives you are 100% tax free. And the fourth option, which gives you flexibility, You choose your pay terms for five. Now this is not a single pay. 5, 6, 7, or 10 years. You get your payouts after 10, 12, 15, or 20 years, all tax free. But the big advantage is throughout the policy term, you have your 10 times cover. Excellent.